Most traders don't fail because they lack knowledge. They fail because every single day they wake up and try to be someone new in the market. New strategy, new indicator, new rules, new hope. And the market doesn't reward hope. It rewards commitment. If you want to survive in trading, you don't need 10 systems. You need one system and the discipline to stay with it when it stops feeling exciting. Let me say this clearly. A trading system is not a set of indicators. It's a decision you make in advance so that your emotions don't get to vote later. When you sit in front of the chart and ask yourself, should I take this trade? You've already lost. A system answers that question before the chart even loads. The professional trader is boring by design. They trade the same market, the same time frame, the same setup, day after day. Not because it's perfect, but because consistency comes from repetition, not creativity. Here's the uncomfortable truth. If you keep changing your system, you are not adapting. You are escaping responsibility. Every loss makes you doubt. Every win makes you reckless. So you rewrite the rules to match your mood. But the market doesn't care how you feel today. A real system does one thing very well. It limits your choices. It tells you when you are allowed to trade and, more importantly, when you are not. And the hardest part is this. You must follow the system even when it loses. Because losses don't mean the system is broken. They mean the probabilities are playing out. Most traders quit right before the edge reveals itself. Not because the system didn't work, but because their patience didn't. Sticking to one system will feel wrong at first. You'll feel slow. You'll feel late. You'll feel like you're missing opportunities. You're not missing opportunities. You're avoiding unnecessary risk. Freedom in trading doesn't come from unlimited choices. It comes from strict rules you trust. And trust is not built in 1 week. It's built when you follow your rules after 3 losses in a row. It's built when you don't trade on days you're emotional. It's built when you show up and do the same thing, even when no one is watching. So build one system, write the rules down, and stop negotiating with yourself, because the moment you stop arguing with the market finally starts making sense. If you want, I can write the next one in a storytelling tone, a hard truth confrontational tone, or a quiet motivational tone. Just tell me which direction you want next. Most traders fail not because they lack knowledge or skill, but because they are constantly chasing new ideas. Every day there is a new indicator, a new strategy, a new guru claiming to have the secret that will finally unlock the markets. And every day, traders abandon the one thing that could have given them real results: commitment. Commitment is the quiet force that separates consistent traders from the rest. Curiosity is loud, flashy, and immediately gratifying. It tempts you to open charts you do not understand, test systems that are unproven, and constantly second-guess what has worked before. Curiosity makes you trade as if you are exploring, but in reality you are gambling. Commitment, on the other hand, is disciplined exploration within a fixed framework. It is doing the same thing over and over, day after day, without needing external validation. Let me illustrate this with a story. There was a trader I once mentored who was brilliant with numbers. He could read price action faster than most people could blink. But every week he switched strategies. One week he was a scalper. The next he tried swing trading. Then he tried moving averages. Every system seemed perfect at first glance. But after 3 months, he was down more than he started. Why? Not because he lacked talent, but because he never committed to one path long enough to see its edge. Trading is not about being the smartest person in the room. It's about doing the same thing consistently, even when it feels uncomfortable. Commitment is not exciting. It does not give you immediate satisfaction. Curiosity gives the illusion of progress, but commitment builds real results. Every system has a weakness. Every strategy has losing streaks. If you abandon your plan at the first loss or when the excitement fades, you will never see its true potential. Think about it this way: if a strategy has an edge, it will show itself over time. That edge is statistical. It works not in every trade, but across many trades. To witness this, you need a long-term commitment. It is like planting a tree. You cannot dig it up every day to check if it is grown. You water it, you give it sunlight, you protect it from storms, and in time it grows. Traders who constantly change systems are like gardeners who keep uprooting seeds. Nothing grows that way. So how do you practice commitment in trading? First, pick one market. Don't try to trade stocks, Forex, crypto, and commodities at the same time. Focus on one. It simplifies your analysis and allows you to understand the nuances of that market. Second, pick one time frame. If you are a day trader, maybe it's the 15-minute chart. If you are a swing trader, perhaps the 1-hour or 4-hour chart. Do not switch back and forth. Third, pick one system or setup. This is your framework. Stick to it, document it, and refine it only after enough data shows its strengths and weaknesses. Commitment also means resisting external noise. Social media is full of opinions, trade calls, and analysis that can derail you. But the moment you start listening to everyone else, you lose clarity. A committed trader trades their system, not someone else's advice. They may review insights, but they do not act impulsively. They understand that consistency beats novelty. Let's be clear: commitment does not mean rigidity. It does not mean refusing to adapt when conditions change. The market evolves and your system may need refinement. But this refinement must be deliberate, based on observation and data, not emotion. For example, if your system shows a pattern of consistent losses over 50 trades, you analyze, adjust, and test. You do not abandon it because you are bored or because another trader tweeted a better strategy. Commitment means controlled evolution, not impulsive jumping. Many traders confuse commitment with stubbornness. They think staying with a system blindly is enough. It isn't. Commitment means patience, discipline, and methodical execution. It means following the rules of your system even when losses come, and even when your friends or forums say you're missing out. Every professional trader you admire has made this distinction. They have stuck with their strategy long enough to experience both the highs and lows, learning the rhythm of the market rather than chasing every wave. Let's talk about the psychological aspect. When curiosity drives you, your emotions dictate your trades. Fear of missing out pushes you to enter late. Greed pushes you to overtrade. You try to anticipate every move, but anticipation is rarely profitable. Commitment changes this. It gives your mind structure. You know your rules, your entry, your exit, your risk. The decision making happens before the trade. During the trade, your job is to follow your system, not negotiate with your emotions. Practical example, imagine you follow a trend following system. The rules are simple: buy when the market is above a moving average, and sell when it is below. You enter trades only on pullbacks that meet specific criteria. You risk 1% per trade. That's it. The system doesn't promise you a win every time, but over 50 trades the probability favors you. If you abandon the system after a few losses because you saw a different setup on social media, you destroy the advantage. Curiosity kills the edge. Commitment preserves it. To solidify this, you must develop rituals that reinforce commitment. Journal your trades, record your reasoning, track your performance. Review it weekly. These practices ensure that your commitment is active, not passive. You see patterns, learn from mistakes, and refine your system with evidence rather than emotion. Commitment is visible in your process, not just your intentions. Finally, understand the long-term impact. Traders who commit build confidence. They understand that losing trades are part of the journey, and that no single trade defines them. They stop chasing excitement and start managing probabilities. They become calm, composed, and rational. This mindset alone separates consistent traders from the majority who panic, jump, and lose. Commitment beats curiosity because curiosity is immediate but shallow. Commitment is delayed but deep. Curiosity promises novelty. Commitment delivers results. You may not feel rewarded every day, but over time, the rewards compound. Stick with your system, your market, and your rules. Be consistent. Be patient. Watch as the edge reveals itself, and in that moment, you understand why commitment matters more than anything else. One of the biggest mistakes traders make is believing that skill or knowledge alone is enough to succeed in the markets. You can read all the books, study every chart pattern, and understand every indicator, but if you cannot manage your emotions, all of that knowledge becomes useless. The human mind is wired to react to fear, greed, excitement, and impatience. Trading without a system is like trying to navigate a storm in a small boat with no compass. You will drift, you will panic, and eventually you will crash. A trading system is not just a set of rules or signals. It is a protective framework. Its primary purpose is to remove emotional decision-making from your trading. Emotions are unpredictable. They make you overtrade, chase losses, enter impulsively, and exit prematurely. A system shields you from these impulses by giving you pre-defined criteria for every action, entry, stop loss, and take profit. When the market moves, you do not guess. You act according to your plan. Let me give you a concrete example. Imagine you are watching the USD chart. You see the price rise sharply, and suddenly your mind starts racing. Maybe I should buy now before it goes higher. Fear of missing out creeps in. You enter late, risking more than your plan allows. The market reverses immediately, and panic sets in. You move your stop loss further away, hoping the market will turn, but it doesn't. You exit at a loss that could have been avoided. This scenario plays out every day for countless traders, and the root cause is emotional trading. Now, let's contrast this with a trader who follows a system. The system says buy only when the market is above a 200 EMA, wait for a pullback to the 20 EMA, risk 1% per trade, and exit at a 1-10, 2 risk-reward ratio. The moment the market shows a potential setup, the trader refers to the system rules. There is no guessing, no fear of missing out, no excitement-driven decision. The trade is either valid or not. If the conditions are not met, the trader does nothing. This removes stress and protects both capital and mental energy. The protective power of a system extends beyond individual trades. Consider a day when the market is volatile, perhaps due to economic news or geopolitical events. An emotional trader might react impulsively, enter trades that do not fit their strategy, and end up compounding losses. A system-following trader has rules that define when not to trade. The system becomes a shield during these high-risk periods, preventing decisions that the trader's emotions might otherwise dictate. Emotions can also distort perception. When you experience a string of winning trades, overconfidence may creep in. You start to believe you can predict the market with your instincts rather than relying on rules. You take larger positions, stretch stop losses, or skip steps in your plan. Conversely, a string of losses can trigger despair and second guessing. You may abandon your strategy, chase the market, or refuse to take any trades paralyzed by fear. A system mitigates these extremes by providing a structured path that remains constant regardless of wins or losses. To understand why a system is essential, it helps to consider the psychology of probability. Trading is not about winning every trade, it is about executing an edge over many trades. Without a system, emotions interfere with this process. You might abandon your plan after one loss or double your position after one win, thinking you are sure of the next move. Probability does not care about your feelings. It only rewards consistent application of rules. A system ensures consistency, which allows probability to work in your favor. Let me share another story. A trader I worked with had excellent technical knowledge. He could spot patterns with precision. Yet he had no system. One day, after a profitable streak, he ignored his usual risk controls and entered multiple trades impulsively. The market turned sharply, and he lost half of his account in a single session. The loss was devastating, not because the market was unpredictable, but because he let emotions dictate his actions. This could have been prevented with a simple, disciplined system that defined risk and entry conditions. A system also enforces discipline through repetition. When you execute trades according to pre-defined rules, you are training your mind to detach from emotional impulses. Over time, this creates a mindset of calm observation rather than reactive behavior. You learn to trust the process, not the momentary highs or lows. This is why professional traders appear composed even during volatile sessions. They are not immune to emotions, they simply operate within a framework that neutralizes emotional influence. One practical method to protect against emotions is journaling. Every trade should include the reason for entry, the system criteria met, stop loss, target, and outcome. By reviewing these logs, you see patterns of behavior, identify mistakes, and reinforce adherence to your system. Journaling transforms emotions into data. When you see that a trade failed because rules were broken, not because the market betrayed you, it strengthens your trust in the system. Another critical element is risk management. Your system should define not only entry and exit points but also position sizing. Risking more than your rules allow opens the door for emotions to dominate. Fear and greed intensify as larger sums are at stake. A well-defined system caps risk per trade, typically around 1% of your account. This ensures that no single loss can emotionally destabilize you, allowing for rational, consistent trading. Let's also address common misconceptions. Some traders believe they need flexibility to adapt to market conditions in real time. True flexibility is not emotional reaction, it is a thoughtful adjustment to your system based on evidence. For example, if your strategy underperforms during certain market conditions, you may refine the system with back-tested changes. Reacting impulsively to a sudden spike or rumor, however, is emotional trading. A system protects you from these impulses while still allowing for structured evolution. Emotions can manifest subtly. Perhaps you take a trade slightly outside your rules because you feel it will work. Maybe you move a stop loss after entering, rationalizing it as protection. These small deviations compound over time, eroding both capital and confidence. A system makes these decisions automatic. The trade either meets the criteria or it doesn't. There is no room for negotiation with emotion. One practical tool is predefined trading hours. Emotions are heightened when you trade at random times, fatigued or distracted. Set a schedule and during those hours, follow your system precisely. Outside those hours, step away from the screen. The system protects your capital, your discipline protects your mental energy. Together, they create a sustainable trading practice. Finally, understand the broader impact of a system on your life. Trading without structure often leads to stress, frustration, and burnout. Emotional trading affects sleep, relationships, and decision-making in other areas. Following a system brings predictability and calm. You know your criteria, your risk, and your process. Losses are handled rationally, wins are managed consistently. The system transforms trading from chaotic guessing into a disciplined craft. In conclusion, a trading system is more than rules on a page. It is a protective mechanism that shields you from fear, greed, and impulsive behavior. It enforces discipline, maintains consistency, and allows probability to work in your favor. A system does not promise that every trade will win, but it ensures that your actions are rational, deliberate, and evidence-based. Ladies and gentlemen, your emotions will always exist. They cannot be eliminated. But a system ensures that your emotions do not control your trading. The trader who trusts the system is calm, composed, and prepared. The trader who ignores it is reactive, impulsive, and eventually defeated. Protect yourself with structure, follow the rules, let the system guide your actions. In trading, this protection is priceless because your mind is your greatest asset, and without a system, it is also your most dangerous enemy. If you are entering the markets thinking that every trade will be a winner, you are setting yourself up for frustration, confusion, and failure. Trading is not a game of certainty, it is a game of probabilities. And in any probabilistic environment, losses are not just possible, they are inevitable. Accepting this truth is the first step toward becoming a consistent, professional trader. Losses are often misunderstood. Many traders take a losing trade personally, as if the market has rejected them, or worse, as if they themselves are failures. This emotional reaction is natural but dangerous. Losses are not about you, they are about the market and its inherent unpredictability. Your job is not to avoid losses entirely, your job is to manage them, learn from them, and continue executing your edge. Let me give you an example. Consider a simple trend following system. The rules are clear: trade in the direction of the trend, enter on a pullback, risk 1% per trade, and exit with a 1-2 risk-reward ratio. Over time, some trades will be winners, others will be losers. There is no escaping this. A string of losses does not mean your system is broken. It means probability is functioning as it should. A consistent trader understands this distinction. Many traders panic when they experience consecutive losses. They start questioning every decision, second-guessing their strategy, and often abandoning it entirely. This reaction is normal, but it is also exactly what separates amateur traders from professionals. Professionals understand that losses are a built-in cost of doing business. They plan for them, set their risk levels accordingly, and continue following their system without letting emotions dictate their actions. Think about it like this: in any business, expenses exist before profits. A shopkeeper does not close their store after the first week of expenses exceeds income. They plan for periods of loss while trusting that consistent effort will eventually yield results. Trading is no different. Losses are part of the cost structure of probability-based systems. Accepting them mentally allows you to stay consistent and patient. Let's explore another common pitfall. Some traders believe that avoiding losses is equivalent to being profitable. They implement tight stop losses, overanalyze the charts, and hesitate to take trades. While this may reduce the number of losing trades, it also reduces the number of winning trades and destroys the edge of their system. In trading, trying to avoid losses at all costs often leads to inconsistent execution and larger losses in the long run. Accepting that losses are expected allows you to maintain your system integrity and execute trades with confidence. I want to share a story of a trader I once worked with, a very talented young man who was extremely cautious. He feared losses so much that he rarely entered trades, even when setups were valid. Over the course of a month, he missed nearly every opportunity. His account barely moved and his confidence eroded. He thought he was avoiding mistakes, but in reality he was creating them by refusing to engage with the system. Only when he accepted that losses were expected and necessary was he able to start trading properly and seeing consistent results. Understanding the nature of losses also changes how you perceive risk. If you accept that losses will happen, you can size your positions appropriately, ensuring that no single trade can cause catastrophic damage. This is the principle behind risking 1-2% per trade. You are not trying to eliminate losses, you are managing them so that they never compromise your long-term capital or your psychological stability. A critical component of accepting losses is learning to analyze them objectively. Every losing trade is an opportunity to understand market behavior and refine your strategy. Did the trade fail because the market conditions changed? Was the entry poorly timed? Did you deviate from your system? By reviewing losing trades dispassionately, you convert potential frustration into a learning process. Losses become feedback, not punishment. Let's also discuss the psychological effect of losses. Traders often fear them more than they value potential wins. This fear can manifest as hesitation over analyzing setups or avoiding trades entirely. By mentally reframing losses as an expected and necessary part of the process, you reduce their emotional impact, fear diminishes, patience grows, and confidence in your system strengthens. You begin to trade with clarity rather than anxiety. Another important point is the inevitability of losing streaks. Every system experiences them. You may win 5 trades in a row, then lose 3, and then win 2 more. This is normal. Professionals anticipate streaks of losses and plan for them with position sizing, capital allocation, and emotional preparation. They do not try to chase wins or recover losses impulsively. They stick to their plan knowing that probability favors consistency over time. Practical exercise: write down your system rules, including your entry, exit, and risk parameters. Then simulate 50 trades, recording which are winners and which are losers. You will likely notice that even a strong system produces losing trades. This exercise helps you internalize the fact that losses are part of the process and prepares your mind to handle them without panic or deviation. Let's consider the opposite scenario. A trader refuses to accept losses, moving stop losses, holding losing trades, or over-leveraging to recover. This behavior is emotionally driven and almost always leads to catastrophic results. The market does not care about your frustration or your account balance. It only responds to supply and demand. A system protects you from this trap by defining clear boundaries and stopping you from taking unnecessary risk. Losses also teach patience. When you accept that not every trade will win, you stop chasing setups impulsively. You wait for your criteria to be met. You trade less frequently but more strategically. You focus on quality over quantity. This patience compounds into consistent execution and better long-term results. Story illustration: I once coached a trader who was obsessed with winning every trade. After a few losses, he became anxious, took impulsive trades, and nearly blew his account. I asked him to take a step back and focus on executing the system exactly as written, accepting losses as part of the process. Within weeks, his trading became calmer, more structured, and profitable. The key difference was not a new system, it was his mental acceptance of losses. It is also critical to understand that accepting losses builds resilience. Every trader will encounter periods where nothing seems to work. The market can be unpredictable, and even your edge will not perform perfectly in every session. By mentally preparing for losses, you develop the emotional fortitude to endure these periods without breaking your rules. Resilience is a key trait that separates consistent traders from amateurs. Practical method: create a loss buffer in your mindset. Decide in advance how many losing trades you can experience in a week or month without changing your system. Track these objectively. By setting expectations, you remove surprise and emotional reaction, allowing you to continue trading calmly. Another aspect is detachment from outcomes. Many traders tie their self-worth to winning trades. This leads to emotional swings, overconfidence, or despair. Accepting losses as expected events allows you to detach your ego from individual trades. You begin to focus on process, execution, and probabilities rather than short-term results. This mindset is what professional traders cultivate. Finally, embracing losses creates humility and learning. Every loss is a reminder that the market is larger than any one trader. It teaches respect for probabilities, discipline, and patience. The trader who fears losses avoids risk, hesitates on valid trades, and ultimately limits potential gains. The trader who accepts losses executes with clarity, learns from feedback, and maintains consistent growth. In conclusion, losses are not failures, they are expected and necessary components of trading. Accepting them mentally and emotionally allows you to trade your system without panic, fear, or impulsive deviation. Losses teach patience, resilience, discipline, and detachment. They are not signs that the market is against you, they are signals that the system is functioning as it should. Ladies and gentlemen, the professional trader understands that the path to success is not free from losses. It is a path built on acceptance, planning, and consistent execution. Losses will happen. What matters is how you respond. By anticipating them, managing risk, and following your system, you transform losses from threats into tools for growth. Accept that losses are expected, and you gain freedom, clarity, and control in the markets. In trading, the word freedom is often misunderstood. Many traders associate freedom with flexibility, spontaneity, or taking every opportunity the market presents. They imagine freedom as the ability to trade anytime, anywhere, on every setup, chasing profits whenever they feel like it. But the reality is very different. True freedom in trading does not come from limitless choices. It comes from consistency, a structured approach that allows you to operate with control, clarity, and confidence regardless of market chaos. Consistency is the foundation of all professional trading. It is the quiet, almost invisible discipline of executing the same process repeatedly regardless of emotions, market conditions, or past outcomes. Without consistency, even the best systems fail. A profitable strategy abandoned after a few losses or altered impulsively loses its edge. Conversely, consistent execution allows your strategy's statistical advantage to reveal itself over time. Freedom emerges from knowing that your process works and trusting yourself to follow it, trade after trade. Think of consistency like rowing a boat. If you row in random directions, speed and distance are meaningless. You might move, but you won't reach your destination. If you row steadily in the same direction, even if progress seems slow, you will eventually arrive. The market is exactly the same. Random trading, chasing setups, reacting emotionally, this produces noise. Consistent execution, aligned with a proven system, produces results. Over time, results compound, creating freedom. Consider the trader who follows a defined system: one market, one time frame, one setup. They enter trades only when rules are met, manage risk per plan, and exit as defined. Each day, whether winning or losing, they apply the same framework. There is no impulsive deviation, no chasing hot opportunities, no negotiating with fear or greed. This repetition may feel boring at first, but over weeks and months, the cumulative effect of disciplined execution becomes profound. The trader begins to see patterns clearly, make rational decisions instinctively, and maintain emotional equilibrium even in volatile markets. This is freedom, the freedom from chaos, doubt, and stress. Consistency also protects the mind. Trading is not just a financial exercise, it is a mental one. A chaotic trader constantly second-guesses, worries about losses, and celebrates wins prematurely. This emotional roller coaster erodes confidence and clarity. By contrast, a consistent trader knows exactly what to do in every situation. The rules of the system guide action, leaving no room for panic or indecision. The mind becomes calm, focused, and capable of long-term decision-making. This mental freedom is just as valuable as financial freedom. Let me share a story. I worked with a trader who initially traded impulsively, jumping from one setup to another based on tips and social media signals. He experienced bursts of excitement, but ultimately his results were inconsistent, his confidence fragile, and his account unstable. After he committed to one system and applied it consistently, something remarkable happened. He began making decisions without anxiety, reviewing trades with clarity, and developing patience he never thought possible. Over time, his consistency translated into stable profits and confidence, a freedom he had never experienced before. Consistency does not mean rigid stagnation. It means structured flexibility. Your system can evolve as you collect data and refine rules, but changes are deliberate, not emotional. Random alterations destroy consistency, planned adjustments strengthen it. This balance allows you to adapt to changing market conditions while maintaining the core advantage of disciplined execution. The freedom comes not from changing constantly, but from trusting the system and making informed refinements when truly necessary. Another critical aspect of consistency is risk management. Professional traders maintain constant parameters for position sizing, stop loss, and take profit. By applying these consistently, they prevent catastrophic losses, reduce emotional swings, and maintain confidence regardless of short-term outcomes. Freedom emerges because your account is protected, your mind is protected, and your decisions are clear. You are not at the mercy of fear or greed, you are operating within a safe, structured environment. Consistency also fosters clarity and strategy evaluation. When every trade follows a defined system, it becomes possible to measure performance accurately. You can see what works, what doesn't, and why. Random trading obscures these insights. A trader who deviates constantly cannot tell if a strategy has value or if success is luck. True freedom comes from knowledge, knowing your edge, knowing your process, and knowing that when you follow your rules, the probabilities are on your side. Let's examine the psychological impact. A trader who embraces consistency experiences calm even in drawdowns. They do not overreact to short-term losses or become euphoric after winning streaks. Their decisions are grounded in the system, not in mood swings. This emotional stability allows long-term growth and prevents burnout, a common problem for impulsive traders. Freedom in this sense is the ability to operate rationally under pressure, unaffected by temporary outcomes. Practical example: suppose your system produces a 55% win rate with a 1:2 risk-reward ratio. Random execution may produce sporadic wins, but consistency ensures that over 100 trades your edge manifests. You trade fewer setups, but each trade adheres strictly to rules. Short-term results fluctuate, but over time, results stabilize. This is the power of consistent execution, the freedom to predict, plan, and trust the process. Story illustration. I mentored a trader who initially chased every market opportunity, feeling he was missing profits if he skipped trades. His account fluctuated wildly and stress was constant. After adopting a consistent system and applying it without exception, he reported feeling a profound sense of calm. He realized he was no longer reacting to every market movement, but instead following a predictable, reliable process. His results stabilized, and he experienced what true freedom feels like: not chaos, but control. Consistency also allows you to detach from outcomes. When every action is guided by rules, you stop obsessing over individual trades. The focus shifts from short-term results to long-term execution. This mental detachment is liberating. Losses no longer terrify you, and wins no longer inflate your ego. Freedom emerges from this detachment, the ability to act without emotional distortion, guided solely by probability and process. Another key element is compounding discipline. Each consistent trade builds confidence in your system and in yourself. You develop a rhythm, an instinct, a calm awareness of what constitutes a valid setup. Over time, this rhythm allows you to operate efficiently, with fewer mistakes and less mental fatigue. Freedom is the byproduct of disciplined repetition. The more consistent your actions, the more your results compound, both financially and psychologically. Practical advice: create a trading routine. Start each day by reviewing your system rules, market conditions, and your planned trades. Execute trades according to your system and journal each one meticulously. Afterward, review results objectively, noting deviations from rules. This daily practice reinforces consistency, strengthens discipline, and builds freedom from doubt, fear, and chaotic decision-making. It's also important to acknowledge that consistency is not glamorous. It is repetitive, methodical, and sometimes boring. Many traders abandon consistent practices because they crave excitement or immediate results. But trading is not about thrill, it is about control. True freedom is the calm that comes from knowing you are operating within a system that works over time and trusting your process even when results fluctuate. Finally, understand that consistency empowers choices. When you consistently follow a reliable system, you gain the freedom to step away from unnecessary trades, to take breaks without anxiety, and to make strategic decisions about capital allocation, risk, and growth. Chaos creates pressure, consistency creates clarity and agency. Freedom is not the absence of rules, it is the presence of effective structure. In conclusion, consistency is the key to true freedom in trading. By applying a system repeatedly, following rules rigorously, managing risk consistently, and detaching from individual outcomes, you create an environment where probability works in your favor. You gain control over your decisions, calm in the face of volatility, and confidence in your ability to navigate markets long term. Freedom emerges not from chasing every opportunity, but from disciplined repetition and trust in your process. Ladies and gentlemen, the trader who seeks freedom without consistency will always feel chaos, doubt, and stress. The trader who embraces consistency experiences calm, clarity, and true independence. The market does not reward impulsive action, but it does reward reliable execution over time. Follow your rules, apply your system, execute with patience, and in that disciplined repetition, you will discover what real freedom in trading truly means.